Indian Unicorn Valuation by C.A. Harsh Dedhia. Beauty lies in the eyes of the beholder. Value lies in the hold of the acquirer. The above statement holds APT for the new age businesses, which are comparatively newly formed cutting edge technology businesses. Most of these businesses are burning cash and eroding capital, yet, in the eyes of their investors, they are valuable investments. Valuing such startup businesses in the present complex and dynamic world is not an easy task. Although many a times, profit is a misfit for valuing a startup, cash flows often end up in doing little justice to the task they were employed to undertake in the first place. Valuing a startup is similar to connecting the dots and sometimes ought to follow or attempt unconventional methods. Since the advent of technology and internet, such businesses have evolved and augmented from merely a startup to a graduated startup, and the successful ones are now known as unicorns. This article is a humble attempt to understand what goes behind those funding deals and how the unicorns have achieved the valuations they are enjoying. Only time will tell whether these valuations will sustain, whether the new age tech business itself will sustain, or whether they will replace the current top 50 blue chips. Concept and history of unicorns. In the startup ecosystem, a unicorn is a term used for privately held startup company valued at over 1 billion US dollars, approximately 7,500 crore rupees, and is generally venture capital (VC) funded. Eileen Lee, U.S. based venture capitalist, first wrote about unicorns in the venture capital world in her article, Welcome to the Unicorn Club, Learning from Billion-Dollar Startups, 2013. Here, she looked at software startups founded in the USA. In the 2000s and estimated that only 0.07% of them ever reach a 1 billion US dollars valuation. Startups that managed to reach the 1 billion US dollars mark, she noted, are so rare that finding one is as difficult as finding a mythical unicorn, and thus the term unicorn. As for decacorn, it is a term for a company valued at more than 10 billion US dollars, while hectocorn is used for a company valued over 100 billion US dollars. As per data maintained by an information platform website One, there have been a total of 79 startups in India which have achieved the unicorn status till December 2021. Some of the startups at the helm of the valuations are widely known to the markets and media. There are some underdogs in the field of SaaS, fintech, e-commerce, logistics which have performed well as far as their valuations are concerned but are not so widely known, like Times Postman, application programming interface, API, development and testing, valuation till the USD 5.6 billion. Times Digit, general insurer with tech-enabled processes, valuation till the USD 3.5 billion. Times Unacademy, online education like language, programming, job preparation web portal, valuation till the USD 3.4 billion. 1 https www. Venture Intelligence. Com Indian Unicorn Tracker. PHP. Valuing a startup business. Basic premise for a valuation of any company is going concern assumption and fair value concept. Cost approach of valuation cannot be effectively utilized for valuing a startup company since it is difficult to estimate how much money will be spent in future. Market comparable approach is a worthy replacement, but measuring a startup's projections against historical performance of established companies would not lead to a realistic comparison, because projecting earnings for a startup company involves making a definitive judgment on the probabilities of success of a new business. Thus, income approach is the appropriate approach which will take into account the forecasted income from business. While using income approach in valuation, more so discounted cash flow, DCF method. Valuing a company means discounting the future cash flows to present value at an appropriate rate. The value of startups is generally based on how investors and venture capitalists feel they will grow and develop. So it all comes down to longer term forecasting. Like, for instance, in case of Zomato, in the span of 10 years there were more than 10 rounds of funding, starting from Series A to Series J. This means that such disruptive businesses should not be fragile and should have a higher success rate of growth. Thus, more often than not, their valuations have nothing to do with the way they perform financially. In fact, many of these businesses rarely generate any profits when they first get running. Therefore, most of the startup funding deals are not based on DCF method. Thus, in practice there are some other methods which are used for startup funding deals, which are as follows. Gross merchandise value method. For many e-commerce entities, gross merchandise value (GMV) is used to value e-commerce business, where the focus is only on top line of the entity and profitability is ignored. In layman's terms, GMV is the value of the merchandise sold over a period of time, without taking into account the discounts offered, the cashbacks granted, or any other expense in connection to the sale. Thus, to quote a simple example, a commodity worth 1000 rupees was offered at 50% discount, that is, at 500 rupees. Furthermore, the customer was offered a 10% cashback, and thus he paid an amount of 450 rupees for the product. Though the cash inflow is 450 rupees, the GMV is 1000 rupees. GMV is often used to determine the health of an e-commerce site's business because its revenue will be a function of gross merchandise sold and fees charged. It is most useful as a comparative measure over time, such as current quarter value versus previous quarter value. There is also the flip side of this method. Just to attain higher valuation based on the gross value, cheap selling techniques like huge discounts and cashbacks become a trade practice which results into operating loss for the transaction. Another noteworthy point to be carried home is the fact that GMV nowhere considers profitability of the transaction from the e-commerce website's perspective. Thus, many venture capitalists no longer consider GMV as the sole substratum for valuing e-commerce businesses. Venture capital method. It is most common approach to value young companies. It is a valuation based on expectation of venture capital investor. Investor will try to obtain return on its investment commensurate with the risk it perceives. This method starts by defining return on investment, ROI. Objective of investor is predetermined exit date and predetermined ROI. It generally focuses on revenue and earnings and ignore intermediate items like working capital requirements, capex requirements, etc. It also tends to ignore cash flows. In this method, the earnings of the private firm are forecasted in a future year when the company can be expected to go public. These earnings, in conjunction with a price-earnings multiple, estimated by looking at publicly traded firms in the same business, is used to assess the value of the firm at the time of the initial public offering. This is called the exit or terminal value. Discounting the terminal value arrived with ROI to arrive at the present value. Value arrived as above is post-money value. Post-money value is equal to pre-money value plus new capital infusion by venture capital investor. Unit-based economics in case of startups too. There is a certain user-based economics. In the startup language, it is generally referred to as customer cohort. At the outset, it is important to differentiate between a user and a customer. A user may be a paying user or a free user, whereas a customer is generally a paying customer. Accordingly, it is important to note that as a term, user is much wider than the term customer in the startup discussion. Accordingly, for valuing a startup based on the user base, it is critical to work out how much money is the startup expecting to generate from its users. Hence, it is a factor of three things that come into picture. I. Existing users, already achieved, stage of the startup to see if it has a value proposition. 2. Future users, growth potential coupled with scalability. 3. The above two inflows would be adjusted for costs involved, user acquisition costs, as well as business costs. For valuing the existing users, factors like revenue per user, renewal rate, life of user with the startup, and associated costs of existing users are considered. For new users, in addition to the associated costs, the user acquisition costs are to be adjusted to identify the profit potential of the business. User acquisition costs are the costs that are incurred by the startup in acquiring a user. These are in the form of marketing spends, as well as the significant spending in the form of lucrative deals that are offered to the first-time users or to all users in the initial phase of the life cycle of the startup. Business costs are the operational costs of the startups that are required to be incurred by the startup for the purpose of running its business. Some Indian unicorns. In India, till December 2021, there are two startup giants which have attained a valuation of Decacorn Viz, Flipkart, and Bijus. Both of these companies are not listed on any stock exchange. Also, very few data points are available in public domain. So, it is difficult to gauge their valuations. As far as listed startups are concerned, there are three such companies as of now viz, Zomato, Paytm, and Nykaa which have attained a valuation of Decacorn. Thus, one can analyze valuation of unicorns through these three companies. Before we gauge the data points of valuation of these unicorns, a question might arise that how Indian bourses or regulator are allowing such loss-making companies to get listed on stock exchange. Some of the conditions for raising funds through IPO for startups under National Stock Exchange are as follows: 3 times proven track record of at least 3 years of either the applicant company, promoters, or the erstwhile enterprise. Times net worth should be positive. Times capitalization of the applicant's equity shall not be less than 25 crore rupees. Capitalization will be the product of the issue price and the post-issue number of equity shares. As can be seen from above, profit is not the criteria for raising funds through IPO. The net worth of the company should be positive, although this criterion shall not be applicable to companies whose proposed issue size is more than 500 crore rupees. Also, as per the issue of capital and disclosure requirements, ICDR, regulations of SEBI, if a startup can get qualified institutional buyers, mutual funds, AIFs, etc., to back at least 75% of the issue, then they can go public even if they are making losses. Hence, this comparatively new phenomenon of trading of loss business is now allowed by the regulator in India. Zomato Limited. Zomato started in 2008 as an online platform providing food guide and restaurant directory. It eventually ventured into food delivery business. It has a network of more than 3.5 lakh restaurant partners and 4.4 lakh delivery partners, which mitigates concentration risk of business. It has raised funds around 1.43 lakh rupees crore through VC funding before its IPO. Much of the funds have gone into acquisition of companies like Runner, Techigal, Uber Eats India, etc., which has strengthened the network and supply chain of Zomato. It has an impeccable commitment of 13 years and is also recognized as one of the best Indian brands. Business model of Zomato broadly includes times transaction fees. Transaction fees charged from food ordering and delivery ranges from 20% to 25% of the gross order value. Times advertising. Restaurants listing on Zomato pay a fixed fee to get listed on the platform. Times subscriptions. Subscriptions to Zomato Gold Pro from customers to get discount on food and delivery. India's food service industry is approximately 65 billion US dollars, out of which online food delivery business is hardly 7 to 10% as per one management consulting firm, which tantamount to 4.5 billion US dollars. Market share of Zomato in online food service business is approximately 42%. China's online food service industry is approximately 90 billion US dollars. Although it is not a proper comparison considering the per capita GDP and internet usage for food service between both the countries, but overall, it emphasizes that India's market of online food service is not so matured and has ample scope to grow. As can be seen from the above exhibit, till March 2021, Zomato had operating loss. Per unit cost economics was also negative owing to high selling and administration expense. Thus, in such cases free cash flows will not do justice. Use of different multiples like EV revenues, EV gross income, EV user are more appropriate to value such companies. Also, one interesting fact to note is that the enterprise value has been steadily increasing due to VC funding rounds. Post-IPO, Zomato is valued at nearly double the enterprise value as on March 2021. The biggest reason why Zomato is losing money is because it is comparatively a young company that is trying to take advantage of a market with immense growth potential, not because it cannot make money. In fact, if Zomato cut back on customer acquisitions and platform investments, my guess is that it could show an accounting profit. But if it did so, it would be worth a fraction of what it is today. Aswath Damodaran. Paytm, 197 Communications Limited. Paytm started in 2010 as an Indian multinational fintech company that specializes in digital payments. It has a user base of nearly 450 million and has also tied up with 17 million merchants, most of which are QR code-based small merchants. From a payment and wallet service company, it has now expanded its business segments into e-commerce, investing, broking, consumer internet, and payment bank. In short, over time it has used its platform of users to launch itself into almost every online activity. In case of person-to-merchant market of digital payments, Paytm's market share is 52%. Paytm also has plans to convert its payment bank into a small finance bank. As far as offline payment system is concerned, Paytm accounts for nearly 10 to 15% of total person-to-merchant POS machines installed in the country. Telecommunication and data usage have increased in India by leaps and bounds in last decade due to various reasons like cheaper data price, cheaper smartphones, and high teledensity in rural areas. Thus, the interface between business to consumer had a paradigm shift from physical to digital, which has compelled many new age tech businesses to get their payment mechanism on mobile phones too. Unified Payment Interface (UPI) is a path-breaking application layer devised by National Payments Corporation of India for cashless transactions, which allows B2B or even merchant payments. UPI transactions have crossed around 1 trillion rupees daily in 2021. As a consequence, wallet operators already have more merchants signed up than the POS machines set up by all banks cumulatively in the last 2 decades. Digital payments have increased at a staggering rate of 10.5x in last 5 years, which now constitutes nearly 30% of the retail transactions. Retail's digital lending has reached around 110 billion US dollars due to many fintech companies who have ventured into specialized as well as short-term lending through faster disbursements, although average ticket size of fintech loan is quite small. As can be seen from the above exhibit, gross order value is increasing exponentially since Paytm has been expanding its business in all the walks of online transactions. Although the operating profit and PAT have been decreasing since last 3 years, but the interesting fact is sales are stagnant. It gives an indication that the take rate, aggregators charges, on gross order value is decreasing year on year. This is mainly because the company is more focused on the number of transactions rather than the value of those transactions. Although a company like Paytm, which is in supernormal growth phase, can have a pretext of lower take rate, but if the cash burnouts have to be reduced, then the take rate has to increase over time. Again, in the case of Paytm, use of different multiples like EV revenues, EV user are more appropriate to value such companies. EV sales have been increasing year on year, which is too high as compared to some international peers like PayPal and Visa. Interestingly, post-IPO the valuation has decreased from 150,000 crores rupees to Rs. 90,000 crores. Nykaa, FSN E-Commerce Ventures Limited. Nykaa is an Indian lifestyle marketplace for beauty, wellness, and fashion products, started in 2012. The company has expanded from online only to an omni-channel model to sell the products. It has around 80 brick-and-mortar stores in India, along with its online e-commerce website and mobile applications. It claims to have over 3 lakh products across 1,500 brands. It has raised funds around 1.1 rupees thousand crore through VC funding before its IPO. In India, there are 3 modes of selling beauty and wellness products with unorganized retail, organized branded stores, and online marketplace. The first 2 methods face a lot of accessibility issues, whereas online marketplace has resolved this issue. The online market size for beauty and personal products is around 1.2 billion US dollars, which is not more than 10% of the total market of beauty and personal products, as per the management and discussion analysis of Nykaa's annual report. E-commerce operators for such products work on 2 models, either as an aggregator marketplace, for e.g. Amazon, or as an own platform holding inventory, for e.g. DMart. Aggregators are merely a mediator between buyers and sellers and earn some percent of transactions, whereas own platform model holds the inventory in their own warehouse and then sell products using their bargaining power. Most interesting fact, which seldom occurs in startup world, is profits. Since last 3 years Nykaa has reported operating profits, and in the last year bottom line also became positive. This is mainly because Nykaa has opted for holding inventory model rather than aggregator model. This strategy has not only helped the company to sell products at their price, but has also solved a problem of duplicate or obsolete products, as the products that are sold are under the control of their own warehouse. Enterprise value has increased at a rate faster than the increase in sales because of optimizing cost along with customer retention, which has helped the company to report profits. Post-IPO, Nykaa has achieved a valuation of decacorn. Conclusion. Principles of valuation will remain same for any company in all the markets, but conventional methods would need to be replaced by newer methods. Most of the unicorns are money-losing, cash-burning enterprise now, but they are in the early life cycle of the business. Most of them are on track to deliver a viable business model. For such companies, network is the biggest asset. Network carries an inherent value which is gauged by the potential investor and thus, they don't have second thoughts to pump in the money. When such companies grow through their network, it is easier from them to grow. Valuation isn't a one-dimensional game wherein a straitjacketed formula can be conveniently laid down. It is not a uniregressional model. And that is the reason why a loss-making company is traded at a unicorn valuation. Disclaimer: the views opinions expressed in the article are purely of the contributor. The readers are requested to take proper professional guidance before abiding the views expressed in the update. Association disclaims any liability in connection with the use of the information